What if one day you tried to withdraw money from your bank account and it wasn't there? Not because you overspent, not because of a technical glitch, but because the government froze every bank account in the country. No warning, no explanation, just a chilling message. Access to your funds has been suspended until further notice. You might think this is impossible. You might think it's a dystopian fantasy, but history and recent financial trends show us that governments have frozen accounts before, sometimes with little notice and massive consequences. Today, we're going to explore what would really happen if every account was frozen, step by step. The story involves political pressure, economic collapse, and human behavior under extreme financial stress, and by the end, you might never look at your bank the same way again. To understand the terrifying scenario of mass account freezes, we need to start with history. Banks weren't always safe. They weren't always backed by governments or insurance. In fact, for centuries, your money was as safe as the wooden vault it sat in. In 1933, during the Great Depression, President Franklin D. Roosevelt did something that would seem unthinkable today. He declared a nationwide bank holiday. Every bank closed its doors for several days. Americans couldn't access their savings. They couldn't pay bills. They couldn't withdraw cash. The reasons? Massive bank runs and a collapsing financial system. In more recent history, countries like Cyprus in 2013 literally froze bank accounts to prevent economic collapse, limiting withdrawals and even taking a haircut on deposits over a certain amount. And in the US, the Federal Reserve, Treasury, and regulatory bodies have mechanisms that, in theory, could suspend or limit access to accounts during extreme crises. The twist is that these events weren't random. They were driven by a combination of debt, political pressure, and public panic. The stage for a nationwide freeze is rarely a single moment. It's a series of dominoes falling, and often, the dominoes are already teetering long before the freeze happens. So, what would those dominoes look like today? To answer that, we have to trace the origins of modern banking, the rise of digital money, and the breaking points that make such a freeze even possible. The story begins with trust. Banking is essentially a social contract. You give a bank your money, and you trust them to keep it safe, lend it wisely, and return it when you ask. That trust is underpinned by a few pillars: regulation, deposit insurance, and liquidity. Historically, banks have failed when trust erodes faster than assets. In the 19th century, before central banking, banks were regional, and failures were common. People literally lost everything overnight. The creation of central banks, like the Federal Reserve in 1913, was meant to prevent systemic collapse, acting as a lender of last resort. But central banks rely on a delicate balance. If too many people lose faith, the system can still implode. Fast forward to today. Digital banking has made money faster, easier, and more abstract. Your paycheck isn't a stack of bills, it's a number in a database. That convenience is amazing until it becomes a vulnerability. As banking grew, so did complexity. The introduction of digital banking, credit cards, and mobile payments created a system where money is increasingly just entries on a screen. This digital dependency is the rise we're talking about. A system that moves money faster than ever, connecting consumers, corporations, and governments across the globe. But speed comes at a cost: centralization and control. Unlike gold coins in a vault, digital money can be frozen instantly, remotely, and sometimes without transparency. Governments and banks already have the legal authority to block accounts. In cases of fraud, tax evasion, or national emergencies, the infrastructure is already in place. In many ways, we're closer than ever to the theoretical scenario of a nationwide freeze. But it's not just a technological issue. It's a psychological and systemic one. People trust that money exists and is accessible. Remove that trust, and the effects cascade. Now imagine the scenario: massive debt crisis, runaway inflation, or sudden government default triggers panic. Citizens rush to withdraw their funds. Banks face enormous withdrawal, threatening to collapse. To prevent total systemic failure, the government enacts an emergency freeze. All accounts are temporarily inaccessible. Immediate effects are devastating. Everyday transactions halt. You can't buy groceries, pay rent, or fuel your car. Businesses collapse. Payrolls stop. Suppliers aren't paid. Economies grind to a halt. Stock and bond markets react violently. People rush to convert digital money into physical assets, which are suddenly scarce. Think about it. In a modern economy, our digital transactions are the lifeblood of daily life. Freezing accounts isn't just an inconvenience, it's a shutdown of the circulatory system of commerce. Historical precedents show it doesn't end well. In Cyprus, limits on withdrawals caused riots, lost savings, and a sharp contraction in economic activity. In India in 2016, the sudden demonetization of 501,000 rupee notes created weeks of economic chaos. Despite a planned rollout, the difference here is scale. A freeze of every account nationwide would dwarf these examples. The fallout would be catastrophic. Social unrest would erupt as people realize that money, the most basic lifeline, has been removed. Panic spreads faster than any government announcement. A shadow economy emerges as cashless transactions fail, and people turn to barter, cash hoarding, or even cryptocurrencies where possible. Financial contagion spread. Businesses fail, credit markets freeze, and international investors pull out. A domestic freeze quickly becomes a global problem. Psychologists note that financial fear spreads faster than financial logic. Even if the freeze is temporary, trust in the banking system may be permanently damaged. People may withdraw funds at the first sign of instability, creating a self-reinforcing spiral. Governments and central banks have tools, but none are perfect. Liquidity injections, such as printing money or moving funds between banks, may not restore confidence if people can't access their accounts. Partial unfreezes might slow panic, but they also create a perception of inequality who gets access first. Digital alternatives like cryptocurrencies or alternative payment networks could serve as lifelines, but adoption is uneven and infrastructure may be insufficient. History shows that even well-intentioned interventions often fail to prevent long-term damage to trust, markets, and political legitimacy. The patterns are eerily familiar. Debt crises in Greece, Argentina, and Lebanon all involved bank freezes or severe capital control. The more we move away from cash, the easier it becomes to control access to money. Panic leads to freezes, which leads to social unrest, which leads to partial recovery, and then a permanent loss of trust, a predictable cycle. Shocking data underscores the scale. In 2020, global digital transactions surpassed $6 trillion per day. Imagine freezing even 10% of that, it would dwarf any historical bank collapse. Surveys show over 60% of Americans hold the majority of their savings in digital form, meaning a freeze isn't just inconvenient, it's devastating. From this exploration, 3 takeaways emerge. First, trust is fragile. Banking isn't just about money. It's about belief, instability. Freeze that, and the system collapses. Second, digital money is both a convenience and a risk. The more digital our lives, the faster a crisis can spread. Third, history repeats itself. From 1933 to Cyprus to modern crises, mass freezes have predictable consequences. The only question is when, not if, similar dynamics will recur. The truth is unsettling. In a world increasingly dependent on digital money, a nationwide freeze isn't just fiction, it's technically feasible. We may think it won't happen, but history reminds us that the unthinkable often arrives without warning. If this analysis has given you pause, it's worth thinking about your own financial preparedness. Diversification, understanding how money works, and awareness of historical precedents aren't just smart, they're essential. And if you found this exploration eye-opening, hit that like button, subscribe for more deep dives into financial mysteries, and share this video to spark a conversation about a topic most of us prefer to ignore until it's too late. No, 6 your money is only as safe as your knowledge of how it's controlled.